All right, so moving on to things that are, I'm not sure as exciting, but going on to single audit updates. I'll just be discussing briefly the changes to the uniform guidance. Um, ARPA update, not necessarily every single thing in ARPA, I'm mainly focusing on the not enforceable, obligations definitions of what you need to be doing by the end of this calendar year. And if we have time, I'll go over common findings of single audits and how you can maybe avoid getting any of those. All right. All right. These are just some terminologies, abbreviations that I might have in the presentation, or I might say them without necessarily describing them. Hopefully, I'll point them out, but this is what, um, if you're not familiar with single audits or having an audit, this is what these different acronyms will mean. All right, so the uniform guidance, just to let everyone know, I mean, it used to be referred to as the super circular, but that term didn't really stick. I thought that one would probably be the better term, but that really sets the rules as to how grants are managed and also what types of costs and how you charge costs to grants, federal grants, and also implements the Single Audit Act. So the audit requirements of when you get federal awarding, how do we conduct that audit, and so forth. And the objectives were, prior to the uniform guidance, there was various different regulations for nonprofits, for schools, for states and local governments, tribal agencies. So the goal was to consolidate everything so that way you're not really having to look through different guidances. You're just looking at one guidance that standardizes everything, removes conflicts that are within each guidance, and then also focuses our audit approach on audits of focusing on risk, waste, fraud, and abuse. Right. So the uniform guidance, it's broken up into 6 subparts. Probably you'll be focusing on subparts D, E, and F. D really talks about once you've gotten the award, everything that you need to be aware of. How do you charge costs? How are you supposed to do procurements and those types of things? Sorry, E is costs. And then F is our audit requirements. So that describes when do we conduct our audit? How do we determine which federal award needs to be audited? What types of findings need to be reported, and so forth. There are also 11 appendices. These are the 2 most significant, or these areas are the most significant ones, which describe cost rate allocation plans and indirect costs, but not necessarily going through the details of this. This will just give you some overview of what's the uniform guidance or what you'll find. So why is the uniform guidance being revised? So OMB is required to look at the uniform guidance every 5 years. So they took a lot of comments. They proposed making some changes in October 5th, and then they received over 800 comments. And there's a lot of description into the type of comments they received and why they decided to implement some things and some other things. There are a couple of things I wanted them to change, but they didn't really change it, or they kind of met things halfway. So that's why it's being changed. And the guidance or the changes came out on April 4th and was codified as part of the single audit. It's a uniform guidance, which is that codification code there, which is that federal, which is the federal code. This is probably the most significant changes to the uniform guidance that we've seen for a while. So it's almost similar to when the uniform guidance actually came out, maybe not as much, but probably has a lot more changes than what we're used to. And this is effective for awards made on or after October 1st, 2024. So if you have a grant that was issued, you got it, or you recently got it, or you've had it for a couple of years, you would still be following the old rules for that. Any grants that you get after October 1st, 2024, you'll be following the new rules. Federal agencies are permitted to apply final guidance before October 1st, but no earlier than 60 days from that publication, which which will be then June 21st, 2024. So you probably want to look when you get a new grant from, you apply for a new grant and you got the grant agreement, you probably want to review it as to what rules they are specifying you need to comply with to make sure you follow the right requirements. In terms of single audits, we don't need to follow the new guidance until periods that start after October 1st, 2024. So really, we're looking at fiscal year June 30, 2026 as the first year where we'll be conducting the single audit in accordance with the new requirements. Or if you have a different year end, those we don't really see there. Some lucky few don't have to report on June 30th, but that's the requirements. In terms of objectives for revising the guidance, it's really to make a lot of clarifications, change the language so it's more, I guess, user-friendly or easier to understand. Also reducing burden on as a grant recipient, reducing your burden of things you need to follow, be aware of, and also improving flow. I mean, some things I find probably a bit more complicated, or they seem to make it more complicated for no reason, but for the most part, I think they followed what they were trying to achieve. So some general changes here. So in the uniform guidance, it refers to grants and grants agreements. So now they've changed that to federal financial assistance. So for example, there are certain things that you don't receive federal awards in that traditional grant, I guess, application process, like your ARPA funds, for example. It's not necessarily that you applied for a grant and you have a grant award. We have, for example, one client in Southern California that never used to report their federal expenditures for federal asset forfeiture funds, which also you don't apply for a grant, you just receive your share of those federal forfeitures, and any spending is also subject to the single audit. So they've kind of clarified that it's not necessarily grant or grant agreements, it's just federal financial assistance. So now they've just clarified that language. There's a lot of terminology in the uniform guidance that refers to non-federal entity. And sometimes when you're trying to read the requirements, it's very confusing because you're reading non-federal entity needs to do this, the non-federal entity does this. This is subject for the non-federal entity, and you're like, it's easy to confuse it to what the federal entity needs to do, or are we talking about cities? Are we talking about private entities? So now they just refer to recipient and subrecipient. So either you're the grant recipient who directly receives funding from the federal agency, or you're a subrecipient. Maybe you get the money through the county, or you get money through the state or another city, perhaps. So that's some of the cleaning up that they've done. There's terminology in there that refers to recipient and subrecipient, and then sometimes they say recipient or subrecipient needs to do a certain thing. And it's often confusing. Does that mean one or the other needs to comply with this requirement, or both of us need to comply with this requirement? They just clarified that it means both of you need to comply with this requirement, unless we specifically state only one of you need to comply. So, because I've had that happen before, where you try to mention to a client that you needed to do this, and says, well, it says subrecipient or recipient needed to do this. It's like, well, they mean both. They're not saying one or the other. So they just clarified that. Yeah, so just plain language. I mean, arguable for certain things, but for the most part. Some of the most specifics, so cybersecurity internal controls. So there's now a requirement that you have to have cybersecurity internal controls. Doesn't specify which framework, and probably Omar, who will be speaking next, knows more about the various frameworks that your tech IT departments follow in terms of setting up your IT securities. Similar to accounting rules, they have frameworks that they follow, but there's currently nothing that they're requiring you to follow. Probably for larger organizations, it's not a big deal, but perhaps you give grants to nonprofits, like small nonprofits that are not so sophisticated. So when you're giving them that grant and they also need to comply with this requirement, it's questionable or something that you want to maybe include in your monitoring of those subrecipients. For equipment, in terms of the amounts that you need to capitalize, that's changed from 5,000 to 10,000. There is notification that you need to make to the granting agency as to whether any of that property that was acquired with federal grant awards was lost or damaged or stolen. So that's an explicit requirement. When you dispose of equipment, for example, maybe you bought transit buses using FTA money, and you now, it's fully depreciated. You want to auction it off or something. Before you could keep $500 or 10%, whichever is the lower. Now you can keep $1,000. That's it. There's no 10%. It's just $1,000. That would cover your cost for doing the auction and so forth. And then you're also permitted to retain those equipments after the grant period is over. So that is something that you don't need to return that equipment or be required to auction it off. This may probably not apply to most of you, but for tribal governments that are recipients, they can now use their own procurement policy and standards, unless if they don't, then they need to follow the uniform guidance. I probably have really opened the other one as well. So modified total direct costs, that's a definition that's used when you're applying indirect costs. So when you're calculating how much indirect costs you're going to charge to a grant, you would first have to determine what are your modified total direct costs. And that picks up different costs. And based on that cost, you then multiply that by your indirect cost rate percentage, and then you can charge that amount. So as part of that, you could have included your subawards, and you could have included $25,000 for each subaward. So they've changed that to $50,000. So if you make, especially if you're a county that has a lot of, sometimes you look at the expenditures, most of the expenditures are really being made to cities or nonprofits or CBOs as they refer to them. Now that you can pick up 50,000 from each versus 25,000, that can make a big difference. Although a county probably has a negotiated rate, but even then they would still be helped out. The de minimis indirect cost rate, initially it seemed quite straightforward. They're changing the percentage from 10% to 15%, but then I was reading it and it's quite interesting. Before it would say you can charge 10%, and that 10% cannot be questioned. You don't need to provide any backup for how did you come up with 10%. But interestingly, they've changed 10% to up to 15%. So I don't know why the 15% was completely necessary. I think the argument is that sometimes maybe you do have restrictions as to not being able to charge 15%. So perhaps the maximum you're able to charge is 12% or 13%, maybe based on some other requirements from other regulations. And then also federal agencies and pass-through entities, they cannot necessarily question you when you're charging your 15% unless required by federal statute or regulation. So I don't know if that's necessarily some kind of loophole or anything. It's just something that was, I was listening to a webinar that was more done by attorneys. So that was something that they kind of brought up, which was interesting. So it's almost like, this may seem minor, but usually these things are more intentional for some need. But for the moment, there shouldn't be any problem if you charge 15%. Nothing has come up to my attention. So you are permitted with prior approval to give out subawards in a fixed amount. So if you wanted to give a subaward, as long as all the different requirements of the program have been met, you can just issue that fixed amount of that subaward without necessarily supporting all the costs that were, I guess, they call it more of a performance-based grant. So that was up to the simplified acquisition threshold, which was at the time 250,000. They've changed that to 500,000. So, sorry, that's a bit light, but what that says is removal of prohibition of geographical preference. This is usually like a lot of your agencies you may have as part of your scoring of RFPs. If someone locally applied for the contract, you give them a 10% boost in their points or something like that. So that was currently and not something that you couldn't really include as part of your procurement for anything that's funded by a federal award. Otherwise, you're not necessarily providing. It was considered not to be it was considered to be a restriction to competition. So they've removed that essentially. So if you do have that as part of your procurement policy or your ordinance, that you don't necessarily need to eliminate that when you're doing something that's a federal award project. In terms of costs that don't, before these types of costs required prior approval, which are your entertainment costs, membership, subscriptions, professional activity costs. They no longer need prior approval. Doesn't necessarily need to mean that they still need to follow cost principles. It just means that you don't need to get that approval ahead of time. Program income. So for program income, the uniform guidance will now state 3 ways in the way that program income can be used or applied. So there's a deduction method, addition method, and cost sharing method. At the moment, probably if you have program income, it's being used as an addition method where you've received a federal award of say 500,000, you've received program income of 100,000. That means your total project costs or program costs can be 600,000, right? However, with the deduction method, they will still consider 500,000 to be the total project costs, but the award would decrease to $400,000. So from 500,000, they would apply 100,000 of that program income to part of the award, and you would only get reimbursed for that for $400,000. That would be the default unless one of these other methods was. The last one is cost sharing. So if as part of the grant, you have a matching requirement where you're supposed to be using your general fund money or other funding source to match the federal award. If you get program income, you can use that as match for that matching percentage. So different ways. The default, if nothing is specified, would be the deduction method. Otherwise, the grant would specify that. The other change for program income, or the other significant change, is there's no requirement to remit back program income once the period of performance is over. So once you're done with the grant and you have maybe a project or something that is now generating income, you don't necessarily have to remit that back to the federal agency. You can keep it, and you may be able to negotiate what to do with it with the federal agency. Right. Strategic sourcing. So sometimes you may have these shared service agreements. I think with nonprofits, they have a lot of kind of agreements where one nonprofit does something for the other nonprofit, and it's a memo. They have an MOU that kind of comes up with this arrangement. And there was no standard, RFP process or anything to come up with this, but yet they are somewhat negotiated between each other. So those would now are considered to be to meet the competition requirement. Before, you would still need to document some kind of competition or sole source justification. Now it meets the competition requirement. Administrative closeout costs. So as part of the grant, once the period of performance is over, you may need to file a final report or something. But now the period of performance ended, so all these costs that you're incurring after the fact are no longer allowable to be charged to the grant unless you ask for them for an extension or something like that. With the changes, you're able to charge those costs even though the performance period has ended. So if you have to file a report after the grant period is over, like a closeout report, you can charge your payroll or whatever costs you incurred to prepare that report. Whistleblower protections is now explicitly stated as a requirement in the, I don't think many of you probably have to comply with that anyway as part of, but that's explicitly required now in the grant, which may, even though you may comply with it, you have to keep in mind if you give money to subrecipients like nonprofits who may not have it as a requirement, now it's a requirement that they need to comply with. Closeout. So I'm not sure if a lot of you use a negotiated, obviously Berkeley uses a negotiated indirect cost rate proposal. But if you're charging a grant based on a preliminary rate, say you have a preliminary rate of 30% and you're charging the grant with 30%, and then the grant is finished and you filed your final report, and then you have a final rate, and the final rate comes out as 25% or even 35%, you are required to do a true up. So you are required to file a revised report with the final rate to see what that number should have been. I think it's something they weren't really enforcing, probably something you should be doing anyway, but it's something that they are now explicitly requiring in the, it might work out in your favor. Doesn't necessarily mean that they will get. And this kind of also goes back to that, up to 15%, like whether that's related or not, but anyway. Just a few more things here. So there's clarification on pension costs and OPEB costs. Pension costs, before you would charge them in accordance, or it was written that you would charge them in accordance with your written policies. Now it specifies that you would have to follow GAAP. And then also with regards to payments for unfunded pension costs, those you would have to allocate those as long as they're chargeable to the grant. So they're not explicitly stating that you can't charge them unless you can have some basis as to why or why you're allocating a portion to the grant. And then it's more for us as the auditors, but the single audit threshold is increasing from $750,000 to $1 million. Sometimes I've mentioned this to some clients and they get a bit too excited. It's like, well, just because you don't have to get a single audit doesn't mean you have to not follow the rules. You still need to follow the rules. You may still, you may still get monitored by your granting agency. So they may still, look for and ask you questions about all the different grant requirements. But you won't be, I guess, having to deal with it every year, or dealing with us or things like that. So sorry, I don't want to mention, it is still good news, but just wanted to mention that. And then we have to determine what is a large program and a small program. So there's a calculation to it, but generally it's either 750,000 that we use for that, and that's going to change to $1 million. So that might impact which programs you get audited every year. So, or you may have less programs that get audited, even though you have a single audit. Okay. And these are the things that have not changed. So percentage of coverage that we need to meet as auditors, 20% and 40% or 40%. Question costs when we would need to report a finding remains at 25,000. When you have loan programs, we treat those differently on the schedule, depending on when they are considered to be large loan programs. A large loan program is when the total federal expenditure. There we go. They can't silence me. Right? Anyway, but yeah, so if the total federal expenditures, if 50% or more was loans, then we would consider that to be a large loan program. That remains at 50%. Moving on to ARPA, and I'm sorry, again, I can't convert every single thing, but I'm focusing on the obligation definition here. So there were some new frequently asked questions that were published on the Treasury Department's website. And the deadline you need to be aware of is December 31st, 2024. And the important thing here is that you need to be um, you need to be obligating your remaining funds, for ARPA unspended funds, if any of you do have unspended funds, um, by this time, and then you'll be able to incur those expenditures and charge them to the grant or the award in 2025 and 2026. Okay. So mainly they cover, employee costs, personnel costs, interagency agreements. So if you have, for example, community development department that gets into an agreement with public works department on a project for them to do certain things and incur costs and do some work, is that considered to be an obligation or not? So that gets clarified. And then also how to treat changes like contract award, change orders, contract amendments, or replacement contracts. Just some history here. So they issued a interim final rule. They keep calling it interim final rule and not just final rule. But there's um, they received some comments, so they issued this new questions and answers. So the main themes were payroll costs. How do you charge payroll costs? Whether MOUs count as obligations? What are the flexibilities? If you have changes in estimates, or you have a change order, are those going to be permitted or not? So this is the website, but you can probably just Google it and you'll find it easily. In addition to other types of summaries they have available for the changes in the new interim final rule. So yeah, as I mentioned, the main points were interagency agreements, personnel costs, and then also how to cover those changes after that obligation deadline passes. Right. And then also there's an extension of when these reports were due. So I guess you have a week if you submit your reports quarterly, and you have a few months if you submit your annual reporter. So the estimates are not, you're not required to submit estimates, but they're highly recommended just to make sure that something would be considered to be a obligation once you do have that cost. And other changes there. In terms of the timeline of where we are, and I borrowed this slide from a training that was done by the Department of Treasury, but so, from March 31st to December 29th, you were using the rules that were set at that time, and then going forward from December 29th, we're using the 2023 interim final rule, and then by December 31st, 2024, that's when you need to be obligating all your, or you need to come up with your final obligations. And then up to September 30th, 2026, there is a deadline for any Title I projects or surface transportation projects, which are in the new interim final rule. Title I projects are like your HUD type of projects, CDBG, and they have a lot of requirements, or there are a lot of which as to whether a project is eligible or not, and any types of pre-approvals that are required, supplementing and not supplanting. So you may want to, if you do plan on having any Title I projects or surface transportation projects, you may want to check the guidance on that, just specifics as to whether your project will actually be meeting that requirement. But that by September 30th, 2026, that's when all those expenditures need to be incurred by. And then for everything else, you have up to December 31st, 2026. It'd be interesting to see in December 31, 2026, if there are a lot of agencies that still have unexpended funds, whether they will change that. I mean, they've been changing things frequently, but at the moment, those are the requirements. So what is an obligation? So an obligation, the order simply is an order placed for property, services, contracts, subawards, and similar transactions that require payment. the interim final rule updated that guidance. So just go to the next slide here. So it's an order placed on property services contracts, which may include an order placed for property or services, which would be like maybe a purchase order, a contract, a subaward, and then similar transactions, which are your interagency agreements. So that has some requirements. It's not all interagency agreements. You have to still meet certain requirements. And then also payroll under certain requirements. Uh, with regards to payroll, you may have administrative payroll. So that's covered as administrative costs, which are separate. This is more discussing any other project type of payroll that's not specific to administration. And then another obligation is just anything requirement that you have that just comes from having the awards, like a single audit, having the cost of a single audit. That's automatically an obligation. You are still required to estimate, though, these costs. So these are things that wouldn't count as an obligation, so they wouldn't really pass the test. Adopted budget or budget amendment, so you can't just budget saying that we're going to use this for building I don't know, building a road and have no plan, no contracts, nothing. That doesn't count by itself as an obligation. An appropriation of the funds, an executive order, resolution, unless it's some kind of, I guess, meets also an interagency agreement, but by itself is not a written or oral intention to enter a contract. So you can't have an agreement with us or another consultant and verbally just agree that I think we'll enter into a contract. That's not going to work. But grant legal authority to enter into contract, claiming funds under the revenue loss. So this one is where you may get tricked, is that just because you have a revenue loss and you've documented that, that in itself doesn't cover you for anything that you charge under the revenue loss category, because keep in mind that you're only charging for government services up to that revenue loss amount. So the government services are really the item you're looking at. Whether all of those government services that you're planning to cover using the revenue loss category are encumbered and you have the proper type of documentation for the obligation, that's the question. And then also just transferring the money to the general fund, that's not going to work either. Okay. All right. So do subrecipients have an obligation deadline? So even though you receive the money via the state, but you're the direct recipient of your allocation, you're still considered the main allocation. This is more talking about if you have, say, for example, the county give you an additional amount of ARPA funds, but the county is the direct recipient. In this situation, you're not the main recipient, you're the subrecipient. So in that situation, you don't need to do anything more. Once you receive the funds as a subrecipient, it's considered that those monies have been obligated by the direct recipient. So there's nothing to do more here. All right. Yeah, same with contractors. Once they get the contract, it's done. I think I have already started talking about this ahead of time. But so for example, say you're going to use the revenue loss category to cover police costs, for example, or fire costs. If you have an agreement for that with another agency, or if you're going to use your own personnel, then you would just need to satisfy the requirements here for what type of documentation. If you already have, I guess we'll cover payroll next, but as long as you meet those requirements, then you're good. But having nothing is not going to be sufficient. And then I think this would be in part of your report. As to, I believe you'll be describing as part of your reporting under that project for revenue loss, will describe what those, the precise government service that you're really paying for. Yeah. Right, so that's just the requirement there. right? Sorry if that's hard to read or not. Um, so this is describing personnel costs. So the key here is that your personnel costs are, as long as that position is budgeted or that position has been established prior to December 31st, 2024, then you're fine. So you may have, for example, if you're planning to use the funds to cover police officers, if your police officer's position is already established in the as part of your budget, then there's nothing to do further there. Um, you may have changes in salary that's anticipated, so that will also be covered. So if you did a COLA or you have to increase people's salaries, that would be covered. As long as those positions are going to be for eligible projects. So as long as it falls under one of those eligible categories for how you can use the ARPA funds, then it'll be covered. So the costs that will be covered are salaries and wages, the benefits, and then also payroll taxes. I think I might have more information. Okay. So that didn't work as well as I wanted. Anyway. All right, so this is more on payroll. So again, as long as the position is like, okay, just got it here. So can you replace or rearrange personnel after the obligation deadlines? The question is, yeah, the answer is yes. So as long as all that whatever positions you're rearranging were all established, you can, and they're all eligible for eligible projects, you are permitted to rearrange those if you decide to change how you want to expend those funds. Okay. So also, yeah, I guess this is a similar example. So you may reorganize, sorry. Okay, there we go. So you may have 10, you may have obligated 10 positions for job training specialists. And then one of the employees got promoted. You're permitted to replace one of those positions with the, whatever what they were promoted as. Maybe they were promoted as supervisor. As long as there are 10 positions still, and they're all within that scope of the project, then that's permitted. Right. And you cannot use the funds, you cannot replace obligated positions with new positions that were established after December 31st. So if you came up with a new type of role or job position on January 5th, 2025, you can't cover that position, unfortunately. It has to be anything that's already established prior to December 31st. Okay. All right, so moving on to cost estimates. So there's no requirement to submit cost estimates, and I believe now there is guidance on how you would report those estimates as part of your quarterly or annual expenditure report. And you are required to, for your legal and administrative costs, you do need to estimate those if you plan to charge them, if they are not already accounted for as part of another project. So you may have already have another project, and you already has, as part of that project, you already have those costs specifically identified. However, if you have other costs that you plan to incur but are not yet being reported on the your expenditure report, then you may want to report them as part of the estimates. Okay. All right, and it has to be reported by the deadlines, and we'll cover the deadlines on the next slide. So for both personal cost estimates and also for the admin legal cost estimates, they're not mandatory, but they're recommended. And those are the various submission deadlines for those different types of costs. You have personnel costs are they're due on January 31st, 2025 and April 30th, 2025. So it's far away. With regards to your admin and legal cost estimates, you have about a week if you're a quarterly reporter to report those. And then you have about, I guess about less than, you have 8-9 months for if you're an annual reporter, and that's an extended deadline. So that's something that they've changed up. Both require reasonable justification for how you came up with that estimate. So you can't necessarily just ballpark it and say, well, I think I'm going to incur about $200,000 for this, or and $500,000 for this, and $1,000,000 for that. You have to have some basis. They might question you as to how did you come up with that. So, uh, looking at historical information, looking at recent transactions, that might be a good way to come up with that estimate, adjusting for inflation, regular normal increases. And then there's no real penalty if your actuals come up slightly different from your estimate. You're not going to be penalized for that. Well, you only estimated this much, so we're not going to let you take another 100,000 because that came extra. I think within reason, they should be reasonable with that. And then you are allowed to reclassify expenses from project to project. So just because you went over on one project and went under another project doesn't mean that they're going to let you that you can reallocate your obligations from one to the other.
Sorry to interrupt, Mitesh.
Right.
If you don't mind, please turning off the phone. It's the phone that keeps ringing. If you don't mind, please turning it off. I would appreciate it.
Oh, sorry. All right, moving on to interagency agreements, whether they count as an obligation or not. So as I mentioned, they do, as long as they meet certain requirements. Let's see here. So they need to meet one requirement from column A here, which is imposes conditions on the use of funds, governs provision of funds from one agency, department, or part of the government or the other, or governs the procurement of goods or services. And it needs to meet or have all of the items in column B there, which has specific requirements. So it can't be too generic, it has to be a bit precise as to what that other department or agency is going to do. It has to be signed by all parties, and then also needs to not disclaim a binding effect. So essentially, it can't say that this can be waived and we can disregard it. Otherwise, it's not really an obligation. Okay. So what flexibilities are there for anything that, happening with contracts after the obligation deadline? So they do recognize that, life happens and things change. So with regards to change orders or contingencies, so you would have to include a portion of that as an estimate. So if you do have a contract and you anticipate that it may change in the future in 2025 and 2026, you should have a contingency there or an estimate for how much that may change. You do also need to make sure that on the contract, it allows for the change order. So if your contract doesn't explicitly state that, we will do change orders in this specific way, then you are not going to be able to consider that change order to be an obligation, or you are not going to be able to adjust the obligation amount for that. I guess the other thing that's quite similar is amending the contract. So it's quite similar to a change order, but here maybe you're adding to the scope of work or minor details there. Similarly, it needs to specify that in the contract that this is permitted, not necessarily that you're coming up with after the fact. And then also they still have to be substantially the same scope. So you're amending the contract, adding a few things here and there that came up, maybe as part of the design process, they noticed something that you need to actually do something more, and otherwise you can't move forward with the project. So that is permitted. And then replacing the contract. So maybe you entered into a contract already, but for some reason you need to replace the contract with a new contract. That's permitted under three sections. So first, maybe the contractor went out of business, so you need to find a new contractor. So you are permitted to replace the contract. They don't have to be necessarily the same amount. So the new contract can be higher than the old contract. You may mutually agree to terminate the contract with the contractor. Maybe things are just not working. And the third is that if you noticed in the awarding process there was a problem and you need to now go back and rebid for that project, that would be another reason where you're allowed to replace the contract. But you would need to document in good faith that this is the reason why this is such a big kind of um, problem that you need to replace the contract. And then these are the various questions in the FAQs where you can get more guidance on those items. And then you are also allowed to reclassify funds between SLRF projects to cover modifications. So if you notice one project is coming under, the other one looks like it's going over, you're allowed to move reduce one obligation and increase the other obligation. So make sure time. Okay, I have about 15 or minutes or so. All right, and this is just a summary of what we covered. So mainly just interagency agreements, personnel costs, and then also contract amendments. Okay. And that's the website where you can get that information. All right, moving on to single audit findings. So I'm often confused, or not confused, but it's not necessarily, I guess the industry standard is that the single audit is only the audit of the federal awards, and really the single audit is combined audit of, of the financial statements, the federal programs that are selected to be audited. So it's not necessarily, if we have single audit findings, they may be things that relate to your financial statement audit. But because we're also subject to the whole, because you had $750,000 in federal expenditures, we're considering that to be a single audit. However, those audit findings would still be reported even though you didn't have a single audit. So I'm going to mainly focus on the compliance section of the findings, but keep in mind that financial statement findings are also considered to be single audit findings. Those are broken out into also compliance findings, and then also we have internal control findings. So internal control findings can be matters relating to the financial statements or also on compliance matters. Known fraud has to be considered to be a finding. And then if you have material misrepresentation of the status of prior findings, that can be a finding in itself. All right, so what's the point? What's the importance of not having findings? So findings can impact your low risk auditee status. So as part of our audit, we will do an assessment as to whether you're considered to be a low risk auditee or not. So this looks through various criteria. It's not necessarily that you get, I mean, part of the requirements is that you have to have 2 clean audits. So if you're an agency that has, big federal expenditures every other year and you only get single audit every other year, you're never going to be a low risk auditee, even though you have the perfect internal controls. So it's just something that we evaluate as part of the audit, but it's also something that federal agencies look at as well. And that just impacts how many programs we need to audit and what type of coverage we need to achieve, right? And these are the things that would impact your low risk auditee status. So having timely single audits and filings, having an unmodified opinion on the financial statements, having an unmodified opinion on the CFA schedule, no material weaknesses in internal control or financial reporting. So that's something before they would include significant deficiencies. So it was a lot harder to get your low risk auditee status. Now you may have significant deficiencies in financial reporting, but you're still low risk auditee because it's not a material weakness. No going concern issues. And then if we had a large program that was audited in the prior year, which is referred to as a type A program, if we audited that program and we identified material weaknesses in internal control over compliance, which is different from the financial statements, or we had a modified opinion on that program we tested, or we had known or likely question costs that exceeded 5% of the total program's expenditures, then we would also not be able to consider you as a low risk auditee. Right. Okay. So with large type of programs, these are the programs which audit every other year. If we have a finding That's material weakness over compliance, a modified opinion, or known likely question costs for that program. We need to audit that program again. So you may have programs that because you keep getting findings on those programs, they need to be audited again, in addition to any other programs that need to be audited. Then you're just going to have more work to do every year. So if you don't have findings, you reduce that, you'll have a lot easier single audit. Common themes. I didn't want to necessarily, in interest of time, I didn't want to list every single type of situation and all times. It's common themes for findings is just not understanding all the funding requirements. Or maybe there's not, in terms of who's responsible for complying with requirements or knowing that compliance requirement, reviewing the grant. It's maybe you have multiple people involved, the program personnel, financial personnel. Things don't get delegated or understood. And that's where you can fall into getting a finding. Insufficient internal controls. I remember having comments on internal controls that no one reviews this report, and you're required to have internal controls, and it's going to really specify. There's a common kind of feedback I would get or response I would get is, well, the grant agreement doesn't state that I need to have internal controls, so why do I need to have internal controls? And actually, because you are required to follow the uniform guidance, in the uniform guidance, it specifies that you don't need to. So it may not specifically, explicitly state it on the grant agreement, but because you need to comply with the uniform guidance, inherently, then you need to have internal controls over compliance. Yeah. Lack of documentation. So same like with our audit work, if someone said they did something, but there's nothing to show for it, then we have to assume it didn't get done, even though you may have done a lot of things. We can't give you credit for it, unfortunately. So any type of requirement where you're meant to meet a compliance requirement or you're trying to document that you did an internal control, you do need to have documentation for it to prove that you did do it. Unfortunately, we can't take word that it was done. And then inadequate subrecipient monitoring is another area that's quite confusing. So in going over and not understanding all the funding requirements, so just certain things, I think when we normally see it when there are changes. So for example, for FADA, sorry, everyone refers to it FAFADA, it's the Federal Funding Accountability and Transparency Act reporting. That's when you're a direct recipient of a grant and then you subaward that grant to other nonprofits or other agencies. There is separate reporting that you need to do on usaspending.gov. And a lot of agencies are not aware of that because it's relatively new and it's something that wasn't being enforced. So it's not something that we've looked at. Usually then people don't really find out about it until people get findings, and then you're like, oh, I got it. I need to do that. COVID-19 waivers. So during COVID-19, during the pandemic, a lot of federal agencies issued waivers that you don't need to comply with this anymore because you can't do on-site visits or on-site inspections. However, a lot of these waivers have now expired. So you can lose track. If you're not keeping track of what you need to do, what you don't need to do, or when things stopped, that's usually when we see a lot of findings there. Miscommunication regarding the CFA reporting, just miscommunication between program and fiscal staff as to when did you incur expenditures, are you a subrecipient, did you give money to a contractor or subrecipient, do you need to monitoring or not do monitoring, whether you should be reporting the encumbrances as expenditures or reporting expenditures. Usually miscommunication also causes a lot of problems. So these are some resources that are available, in terms of if you're not sure about whether the requirements of a grant or if you applied for a new program you never received before the funding, what kind of resources can you look at to get familiar with it or get some information. So we have a document we look at for a single audit every year called the OMB Compliance Supplement, and it's issued and updated every year. And it's really, as us as the auditors who don't deal with federal programs and each and every single federal programs, it's not expected for us to know every single requirement for every single program. So there's a lot of detail in the compliance supplement about that program, what are the different ways funding can be used, what are the various requirements. They're not going to specify every single requirement. They just focus on what the most critical that they want us to look at. So, but it is like it is a resource. It also has an appendix with federal agency liaisons. So if you have a HUD grant and you don't know, you have a question about that grant, you can go to the compliance supplement, go to the appendix, and they'll have phone numbers for different, probably for HUD, they have many. So at least a resource where you can ask questions and so forth. You normally get a grant liaison, and then also us as the auditors, we are also available to answer questions. Insufficient internal controls. So the design of those internal controls. So sometimes you may just have some process that you put in place, but do they really accomplish anything? And then also the operating effectiveness of those internal controls. So a good example of this is that, and we also often see errors is in maybe your reporting. You do this quarterly financial reporting. So it's like, well, yes, this person prepares it, and then it goes to this person to review and sign, and then eventually it gets submitted to the federal agency. And then you look at the report and you're like, well, where's the backup for this report? They've run your report, and then none of the numbers are matching, nothing is tying out. So you question whether, yes, the report is signed by whoever was meant to review it, but there's no, did they do review it? Or maybe there's miscommunication as what review actually means, like reviewing what exactly that is intended. So a good tip is, again, the compliance supplement, part 6. So as part of part 6, it has a whole list, an inventory of internal controls for various compliance areas, suggestions for control environment, monitoring, control activities. So procurement, you can cover every single compliance area. You can see what you may want to implement as part of your overall grant compliance. Lack of resources. I think many of you can probably vouch for this one, just that we don't have enough people, or people who are supposed to do something left, and now we have a new person. We have to train them how to do it. They don't know how to do it. So that's where things slip through the cracks. And unfortunately, it's not necessarily, it's that you can give it as your explanation of why there's a finding, but unfortunately, it's not something that you can use to then, try to remedy the finding and say, well, we don't have enough resources. Well, you did accept the grant and accepted the requirements of the grant, so it is expected still. Okay. So what can you do again with regards to internal controls? Continual risk assessment. So, in terms of how things can go wrong, keep asking yourself that every year, perhaps. So if we got this new grant, some grants you get every year, you can keep reviewing it and have some process as to continuously looking through whether you have sufficient processes, internal controls over different requirements, and then also seeing if they've added any new language or requirements in there that weren't there before, that now you need to think about, well, does that impact us? What do we need to do differently? Asking why in the review and redesign of processes. So, sometimes you may be doing something that's not really achieving anything, and something that someone came up with 20 years ago or 30 years ago that you're just doing it, but it's not really achieving anything. And maybe you can take that time to do something that will actually, actually achieve that prevention of non-compliance. Leveraging technology. And this is something where it's actually, you can be quite, I think I was just talking with Jan about things like DocuSign, for example, where, having a report go through a review process and routing things, not vouching for DocuSign, the many other services, but things like that, where maybe before there were limitations in routing a document to get it reviewed, and that's why there's a constraint. But you can now have many different ways of doing things that will just make things a lot easier and help you comply with the requirements. Encourage cross trainings and team collaboration. So the more people you have involved in a process, then the risk that when someone leaves, all of the information leaves with them is mitigated, because then you have other people who may be able to cover as an interim temp, or may be able to train someone new when you hire them. Okay. Also adding written policies and procedures as much as you can, so that way someone has a way to know what to do when they're trying to take over. All right, use temporary or external resources. I mentioned the compliance supplement. Okay, I think I'm almost out of time. So just to wrap up here, lack of documentation, as I mentioned, if things are not kept or filed or saved, we have to say that, that they're not done. The common ones are, suspension, debarment, where you are permitted to go online and search for a vendor or contractor online and see if they are debarred or suspended from entering into getting reimbursed by a federal awards. And usually you search, you don't find them, and you're like, okay, we're good. They're not debarred or suspended. But when we're doing the audit, or when you get monitored and said, well, did you do this or not? There's no historical information. You have to do a printout or something or a screenshot to show that it was done. Certified payrolls being not kept for the amount of time, insufficient information to document. So if you have doing housing inspections, but your checklist for the inspection doesn't cover all the requirements that you need to make sure that you did every single aspect of what was needed for that inspection, or you're doing subrecipient monitoring, um, then that could be a problem. All right. Subrecipient monitoring, I think the main theme here is just not knowing whether an entity or contractual agreement is a contract or is it a subaward. You're giving a contract or you're getting into agreement with a nonprofit for them to do certain things. Are they a subrecipient or are they uh, a contractor? And there is this checklist, or not checklist, but a guide on that CGFM website that can help with that. And then keep in mind that if you are a pass-through entity, you receive federal funding and you're passing it along to another agency. That doesn't mean you're hands-free and you can now continue on with other business and the subrecipient is now responsible for doing everything else. You as the primary recipient have pass-through entity responsibilities. The pass-through entity responsibilities are in the uniform guidance. They would include things such as doing a risk assessment of the subrecipients to determine the level of monitoring that's required. So if they are a subrecipient, they have a single audit, they're always clean, they always do their reports timely, you may want to do less monitoring on them. Versus you have another subrecipient that hasn't received federal funding ever before, they submit everything late, they have a lot of turnover, then maybe you want to be more hands-on in their monitoring. And monitoring doesn't mean you're doing things just after the fact. Monitoring could be things like providing training, being involved in certain types of aspects of the program. So monitoring can cover different things, including if another pass-through entity responsibilities, you have to obtain single audits from those entities, review it to determine if there are findings. If there are findings, you are then the person responsible for and following up to see if they've actually remedied that finding or not. And that impacts the CFA reporting also. And here's another thing from the AICPA, just key recipient roles and responsibilities for single audits. That's another resource for you. Yeah, here's another one. Yes, I guess I copied that twice. I don't know. But yeah, I think that is it. So if you have any questions, feel free to email me or Ahmed. Otherwise, thanks for your time.